Hello and welcome to this exclusive conversation on long-term investment ideas from ICICI Prudential Mutual Fund. Uh, I'm sure everybody would be interested in knowing why and how to invest in mutual fund schemes after the grand success of ICICI Prudential Flexi Cap Fund, which collected highest ever amount of 10,000 crore rupees in new fund offer. Joining me is Mr. Chintan Haria, Product Development and Strategy, ICICI Prudential Asset Management Company. Welcome, Chintan.
Thank you.
Chintan, to start with, Nifty hit a record high once again. Currently, equity markets are at a record high. A very smart recovery from the lows that we saw in March 2020. What has really helped the market and what is supporting it? Because we didn't see any deep corrections in between. I mean, a slight bit of corrections, but it's holding up and it's moving higher. So what is the main reason of markets holding up?
So thank you for your wishes for the collection of the NFO. I think I should also thank every investor who has participated in it. And more importantly, we feel that the journey for India's movement from financial savings in only fixed income or majority in fixed income to equities has just started. It is reflected in the increase in demat accounts. It is reflected in the markets being at highs. It is reflected in the turnover, which is increasing in the market through HNIs and retail. I think it's a wave. Of course, as a word of caution, all waves can sometimes give pain to investors as well. So we need to be cautious how we're investing. And that's where when we were discussing the FlexiCap NFO and speaking to investors, we were highlighting the importance of two main things. One is asset allocation and second is your allocation to large, mid and small cap. If you can manage these two well over the long term, Indian equity markets do have opportunities aplenty across many sectors. So we believe that this is the start of the journey in terms of India's growth for the next 10 years, 15 years. Demographics is, of course, in our favor. Also, the large liquidity globally means that even foreigners are looking to invest in India in a big way. You can see the all-round enthusiasm which is there among some of the IPO names as well. Investors should probably be careful when they are picking up stocks themselves and investing because it's a science and an art both which needs to be taught and where professional fund managers come in handy. Hence, I think the success of FlexiCap NFO gives us a lot of pleasure because of the fact that investors' money will be managed in a professional manner. And we just feel that there is a lot more in terms of Indian investors investing in equities as we move along.
When we talk about the corporates earning, we were expecting the earnings to really pick up, but just because of the COVID second wave and because of the higher commodity prices and crude surging in the international markets, do you expect a certain kind of a delay in corporate earnings? Expectations that we were initially building up in the companies. So what is your view on the earnings? How do you expect the earnings to pan out in the next, say, 4 to 5 quarters for corporate India?
Sure. So if we look at the earnings, we have to step back towards what's happening in the last 13 months. And I'll probably try and encapsulate that. We have seen from March 2020 a synchronized global money printing / central bank easing of liquidity. In other words, all central banks have pumped in liquidity in the hands of people and in some form or the other. And that has basically meant that people are demanding more goods and services. And across the board, if you look at it, agri-commodity prices, wheat, soya, corn, cotton, they are going up. If you look at steel, copper, aluminium, zinc, those prices are going up. Oil prices are going up. Effectively, wages are also in the Western world going up. I'm sure that push will come in India as well. So across the board, when prices of goods and services are going up, effectively it leads to inflation. And that inflationary spiral or inflationary conditions is generally in the first leg good for equities. So your question on earnings, whenever there is inflation, the sales and profitability of the companies in the first leg of inflation generally improves because they're able to have a better pricing power if demand is strong. Unfortunately, like you said, for India, last 3 months we got stuck with the sad second wave of pandemic, But if we look forward with inoculation drive happening plus the demand scenario improving, we will find this inflationary spiral which is starting will help the corporate profitability to look better, which is already happened. If we see this quarter numbers which have just gone by, and maybe even the coming quarters, you will find that the expected earnings growth is far better than what we have seen in the last 5 years. Last 5 year average in India in terms of earning growth has been 4 to 5% because the inflation itself was low and the GDP growth was low. Now we are expecting GDP growth to be much better than what it was in the last 5 years, and inflation to be higher than the last 5 years. Put together, that should help the earnings of corporates. So, like what we see in the estimates, the next 2 years earnings growth in India are good, and that's where, even though the valuations, the question comes is valuations are looking expensive based on trailing earnings. The valuations are being supportive because the future earnings growth is probably what the markets are looking at.
Chintan, we are seeing this time it's a broad-based rally. Mid caps and small caps are also participating last 6 months. I mean, outperformance that we saw from mid caps and small caps. And ICICI Prudential Mid Cap Fund has been one of the best performing funds in this segment. So, can you please, share some of the experiences and the kind of investment strategy that you're following in your ICICI Mid Cap Fund, and what is the future that you see for this kind of an investment?
So it's a very relevant question on mid caps because I think the last 6 months, especially since October, the rally in mid caps, small caps has been pretty strong. And if we step back to the last 5 years and look at it, the demonetization in 2016, GST implementation somewhere in 2018, and the pandemic in 2020, these three events led to a squeeze in terms of the efficiency of the medium and small enterprises in India. Many of them have shut shop. They are not finding it easy to get capital, and they don't have enough, let's say, balance sheet strength to manage the kind of pandemic that has happened. This has obviously going to impact or positively impact the slightly larger companies in India, which is the mid and small cap companies, which are not the smallest companies in India. So the large cap companies have seen the benefit over the last 5-10 years in terms of getting bigger. But the medium and small, mid cap and small cap segment is seeing the benefit of economic growth right now. And we're trying to capture that in our mid cap fund in every possible way. The fund manager has been able to pick the right sectors where there is growth potential over the next 3 to 5 years, keeping a very keen eye, as always, on the management quality, because in mid caps, small caps, the management quality matters the most. So the three pillars, if I may say so, the balance sheet strength, the future growth, which is there in terms of 3 to 5 year visibility, and the management quality. If these three are basically focused upon, and also having diversified sectoral allocation, there is no single concentration of a particular sector. So because India is such a large country and there are so many opportunities, if you look at our mid cap fund, it is trying to capture that. And we believe that as we move along, that's a space where investors should have allocation. It will remain a high volatile segment. And in the long run, the longer you keep, the better it will be for investors, is what we believe.
Chintan, ICICI Prudential is known for its wide range of asset allocation schemes. Do you think it's right time to really get into investing through mutual funds? And if yes, which are the best schemes and which are the best products that retail investors should really get into?
So I think let me go back to 2006, 7, 8, when we were first thinking about these asset allocation schemes in terms of as a solution for investors. For far too long, we had seen investors getting invested in equity markets. When equity markets have done well, then there would be a correction in cyclical corrections in equity markets, which always happen because that's the nature of equity markets. And investors get worried and take out the money. So this greed and fear, putting more money when the markets are doing well, putting lesser money when the markets are not doing well, is something which is impacting the journey of wealth creation for every investor in India. And you would be surprised, even sophisticated investors find it as a pain area in terms of their wealth creation journey. And hence, we have structured a very wide range of solutions around the dynamic asset allocation funds, where investors can find different ranges of equity levels for which suit them. However, if I have to pick and choose one which we believe is fit for all investors across the board to start their journey, or to be invested in equity markets in a conservative manner while trying to capture upsides of equities as well, it would be the dynamic asset allocation category fund, or the balance advantage fund as we call it. It is a leader in its space. It has been for a long period of time in terms of the persistency and repeat purchase as far as investors is concerned. Also, we've seen strong, because the simple concept with which our balance advantage fund runs is buy low, sell high. It is intuitively something which sounds easy but difficult to execute. And on a day-to-day basis, based on our dynamic price to book model, we are able to see the valuations of the market, and based on valuations, we will allocate equity in the right proportion for the investor in the balance advantage fund. Now, that's something which we truly believe should be a part of every investor's portfolio, the most aggressive investor, conservative investor, because you have certain core portion which you want as a foundation or a steady rock, which will allow you to then build on your overall equity allocation. So hence, the balance advantage fund is something which we'll strongly recommend for all investors to start their journey, be it lump sum, be it SIP. We are very confident that it will help you in participating in equities in the right manner.
Chintan, we have seen in the investment environment in India, if we talk about the retail investor, it so happens that when there's a deep correction in the market and they have been investing through SIPs, they stop their SIPs or try to redeem the kind of investment that they have done in the mutual fund. Is it the right strategy? I mean, if there's a correction, shouldn't be one buying more?
So it's very interesting that SIPs are the best ways for investors to invest in a manner that whenever the market's correct, they get the advantage of rupee cost averaging. That is a lower market level to put more money, and it happens automatically because your SIP is already established. To invest out of your own when the markets are fall is a very difficult art or very difficult to execute. But if your SIP is going on, it will automatically happen. Now, the biggest mistake which, like you said, investors make is that, let's say in March 2020, when the markets fell, after that you get worried and you stop your SIP. What has happened? All throughout, when the markets were much lower, you did not get to participate in the market or increase your investments in the market. You get much more units if the markets are at a lower level. And hence, we strongly believe that SIP is something should be a part of your portfolio, and do not stop it. Have a goal that for 10 years I will do SIP, and eventually you will get the benefit of the markets doing well. You should not stop your SIPs. And more importantly, if I see, what does SIP do? See, we earn every month, we save every month. A certain portion of our savings we do have to invest. SIPs will automatically take care of that habit of savings as well. Because if we know that 20 to 30,000 rupees or whatever the amount may be is dedicated towards SIP, we will automatically force ourselves to save. And today I'm seeing the biggest problem is not about people making investments. People are probably forgetting that it is important to save first and then invest. SIPs are a way of forceful savings in that sense, which is the right way for the investor to go by.
Rightly said, Chintan. Let's talk about the sectors. Now, if we look back and see the performance of the sectors in last 1 year, your IT, technology, metals, and pharma has performed well. But banking is still underperformer, and for sure, COVID has been the major reason, because the kind of moratoriums and all were extended as a relief to the customers. So what is expected now? Which are the sectors that you think should make money for investors, say in coming 5 to 10 years?
Clearly, any economy, if it has to grow, the lifeblood is the banking and financial services system. Within that, if we see in India for the last 7-8 years, we've gone through a cycle of non-performing assets, that is bad debts getting written off. And those were obviously because of the previous 5 years, so 2007 to 2012-13, whatever large projects had been announced when the markets were doing very well, they went through a cyclical downturn. Banks had to take write-offs. We are in probably a reverse cycle where we will see inflation leading to corporates, increasing their capital expenditure. And when the corporates increase their capital expenditure, the loan requirement from banking system may go up. As you are aware, we are at a 3-4 decade low as far as loan growth is concerned. And that is not surprising because our capacity utilizations are low. So from a banking system perspective, clearly, we are seeing the economic growth over the next 2 to 3 years will get reflected in their banking businesses itself. And today we are starting off from a clean state, literally, in terms of the NPA cycle. It's at its low. So the whatever growth in loan and business happens, will impact positively the corporate banks. So the corporate banking space we are positive on, and the larger banks we are positive on. Apart from that, of course, power and utilities as a segment, including telecom utilities as a segment, we are pretty positive on. But if you have to ask me one sector which will probably help India in the next 2 to 3 years in terms of its growth and will reflect, it will be the banking and financial services sector, especially the corporate banks.
Let's talk about the international market. Strong performance globally. I mean, your Dow Jones, Nasdaq, your FTSE are at a record high, and there has been an increased interest from the investors in India, investing in the international markets and international funds. So, what would you suggest, retail investors if they're really interested in getting into some international funds?
So clearly, if we see in terms of the overall allocation, we say that people should have a balanced allocation and they should have exposure to the right asset class in right proportions. And as part of that, Indian investors who have had equity exposure in India, they are expanding towards having equity exposure outside, which is not wrong because India is 3% of the global GDP. There is a large audience out there, a large number of companies out there, internationally also, which can form part of the investor's portfolio. However, of course, the pushes and pulls in the global market are slightly different. You mentioned that the performance of international, especially the US markets, has been pretty good in the last 5 to 7 years. The reason is understandably there have been tax cuts there, the business buoyancy has been strong, and their employment ratios have been at very strong levels. Plus, interest rates have kept on coming down in US. So when interest rates come down, the valuation re-rating of equities has happened strongly, and we know that it is the innovation capital of the world, and that has also helped their markets do well. So clearly, as an allocation, if investors want to diversify, maybe 5 to 10% they should start. Not put all the investments at one go because, as you mentioned, the external markets or international markets, especially US markets, have already done too well. But you can start, from your investments and then probably start in a diversified fund like the ICICI Prudential US Mutual Fund is one example which I can think of. It is diversified; it is not concentrated in a particular sector, which probably is better today because if you look at the tech names, they've already done too well. So you can have a certain allocation, but in a diversified fund, it would be probably better. Diversified international fund.
We all know that there has been a retail rush investing directly into the stock markets with demat accounts nearly doubling in less than 6 months. So what would you suggest to the retail investors who are investing first timers in the stock market? Should they invest directly, or it is sane to invest through experienced fund managers who know how to really manage the funds and create wealth for the retail investors?
So it's very heartening to see youngsters investing in equities, and I think that's the advantage of the digitized world, wherein access to information, access to even markets, and is much easier today. And as people invest at a young age, early age, with probably their pocket monies or their first salaries, they will also probably learn what mistakes happen in investing because unlike any other thing, unlike most things, investing mistakes you learn on something once you do it. And to that extent, it is a very heartening thing that we are seeing a equity culture building in India. However, if we go by the experience of the West and also in the Indian context, it is always better to probably entrust a large part of your money to money managers who are doing this as a profession, who are probably spending hours and hours studying companies, sectors, looking forward in terms of what may do well, rather than probably what has already done well. Because most investors, when they are investing today, they'll be probably investing in stocks or in segments which have already done well. They may continue to do well or not is something which we do not know. But as fund managers who are supported by a very large analyst team, they are able to look forward. Also, they are able to manage the risks with a diversified portfolio of 35-40 stocks as the case may be. So to all new investors, I would say, do invest, not a problem. Direct investing is also very, it's a learning journey. If you have the ability and the time to go through the balance sheets, to go through what the businesses are doing, there's no wrong or right in that. But if you can have a very balanced portfolio across your mutual funds as well, in the long run, it will help you to participate in the right manner in equities while also ensuring that your risk controls are in place. And of course, you don't have to worry too much about then, following up with all your investments because the fund manager is doing it for you. So clearly, if I have to sum it up, you can have a core portfolio of balance advantage fund, build it up with the flexi cap funds, and then international equities. Like I said, if you want US blue chip, etc., you can build a portfolio which then you keep adding on and create wealth. It will allow you to spend time on things which you like the most because you may have a profession or a business which may be different from equity investing. And you can focus on that while obviously the money managers do their job in terms of picking the right stock sectors for you. The only skill there is, of course, have a financial advisor who will be able to basically tell you what fits your risk profile and what is your right balance as far as having the mutual fund portfolio.
Thanks, Chintan, for your time. It was really a pleasure speaking with you.
Thank you, Geetu. Thank you so much. Thank you, all the investors, for listening. Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.